This is our Forex blog for March 13th, 2012, and one of the easiest ways for new traders to trade is to just simply buy the strongest currency versus the weak and sell the weakest versus the strong using our currency meter. Let's scroll this back to the beginning of the day at midnight, and the real-time strength or weakness shows up in histogram on the top. It's made up of 5 of our best statistical trend tools. 3 of them measure the direction, in this case that the dollar is moving versus all the rest, and 2 of the 5 measure the intensity. So anytime it's at and above the 80 level in red, it's extremely weak. A perfect pattern that tends to continue is when you have a lot of weakness like this followed by very little amount of strength. That weakness tends to continue, and you can usually anticipate that. Underneath that we have the daily, weekly, monthly. Ideally, you want to find a currency that's weak, that has a weekly and monthly trend and daily trend that's weak as well. So when they all line up, or you can see in the euro here, a very clear reversal pattern to the downside, especially since there's no strength. The monthly trend's down, the weekly trend's just slightly up. So by just quickly looking at this, some of the ones that were strongest today, that were relatively strong on all time frames, was the CAD, the New Zealand. One of the weakest ones, especially after 3, was the yen. A little bit of weakness here in the Australian. The weekly and monthly trend are quite weak. So those are the ones that you'd want to trade. You could also have traded the Swiss, since the very strong weekly trend kind of went down at 1 o'clock. If it's just barely hanging above water, when you see extreme weakness like this followed by a tiny amount of strength, usually that weakness continues. And you can see it did here at 4. So let's look at some of the trades you could have done. Weak yen, strong CAD, so therefore you want to buy the CAD yen. And as you notice on this chart, it just went straight up. Somewhere around that 4 o'clock area, it was at 83, it went up 90 pips. And there was plenty of opportunities, especially in the beginning, up 20 pips, up 30 pips. And the upper containment band is typically an area where the market reverses. So you basically want to trade with the trend until it gets to or outside of those bands, and then look to exit your trade. If this one was going up but the weekly and monthly trend were down, you might want to look for a counter trend trade up there, and those are very high probability. The higher it is above the upper containment band, the better. Once a currency is breaks out above the previous day's high and comes down and tests it and can't go below it, it's a pretty good chance it's going to go higher. So you might have bought here, made 7 or 8 pips, bought this pullback here and broke even, and then the third trade you can see from around 55 went all the way up to 90. The Swiss was quite weak. You could have, let's actually look at the New Zealand versus the yen as well. Strong New Zealand, weak yen. And notice it's above the hourly right here. It gets a pullback, goes up 10 pips by this pullback. Notice how our intelligent trailing stops are very, very tight. A lot of traders use them as entries, in at 57, out at 86. Obviously, you only want to use the trailing stops to enter into the direction of the trade. This one's above the hourly, so it's more likely to go up. This one has a daily, weekly, monthly trend that's up. Obviously, if you're just focusing on buying, especially when the market's way underneath the lower bands, like right here, in at 86, out at 03. In a 14 pip win, keep in mind, it doesn't take a whole lot of pips per day to double your account every 2 months using very low leverage. For example, $2,000, 10 pips per day doubles your account every 2 months. As you can see, the 2,000's almost 4. Now it's 8,000, and doubling your account every 2 months obviously grows very fast at some point, but your trade size is up to 51 lots. Obviously, you get to a level where psychologically, when you're trading for 500 or 800 bucks a pip, it becomes a lot more nerve-wracking than trading for $30 or $40 a pip that a lot of traders start with. Or if you do mini lots, obviously you're only trading for $1 a pip, which has no anxiety for most traders. The point of showing you that is it doesn't take a whole lot of pips per day to do very well trading. 10 to 20 pips a day is a good goal, especially if you only have an hour or 2 to trade. Just try to get your 20 pips and quit. Because you're bound to have at least 1 or 2 losing days, possibly during the week. If you make 20 pips for 3 days, that's 60 pips. If you lose 10 pips one day and 5 pips the next day, you've pretty much hit your 50 pips in goal for the week. Let's look at some of the other trades we have on here. Very weak Swiss. The CAD was also very strong. So this is not a currency that I tend to keep up and running, but you can buy the CAD Swiss. Take a look at this, just straight up. And you can see the CAD was strong on all time frames, and you had a very clear signal to the downside, a lot of weakness for a couple hours, hitting the 80 level, and then during the pullback phase, there was only one 5-minute bar that had any strength. The rest of it had half the momentum than the previous down move. So when that came back here around 3:30, notice on your chart, right around here, as soon as it broke out above the high here, you're in. Even if you got in here at 92.50 and exited here when it went sideways, you made your 15 pips. You bought again here, made 15 pips, bought it here. And you always want to draw your fibs. When you see a nice move like this, draw your fibs. Most of the time it's not going to go above the 1.618 fib target. And when you get a nice little 1, 2, 3 reversal pattern like this is a pretty high probability place to go short. And one of the systems that we teach is called an Elliott two-way fib pullback system. First, you find a strong currency that goes up a considerable number of pips. You wait for a pullback, and then you draw your fibs on that pullback, and you look to buy between the first and second fib target. This one came down. You would have been long right here. It went up, came down. I probably would have got out of this trade right here. Pull back again. I would have expected it to continue down, but the fact that it didn't, as soon as it goes up, you get in, and you could exit your trade here, buy this next pullback, and so forth, or just kind of use our trailing stops as well. Most of the time, the market does not go above the 1.618, so I would have been out of the whole thing here around 32, and maybe missed another 10 pips that it went up.